Welcome once again to our commerce classroom. In this session, we will discuss about buyback of shares. Buyback of shares. All of we know that buyback of share is a method of cancellation of share capital. Buyback of share is a method of cancellation of share capital. Buyback of share means buying of own shares. Buyback of share means buying of own shares. It leads to reduction in the share capital of the company. Buyback of shares leads to reduction in the share capital of the company. Section 68 of the Companies Act 2013 mention about power of a company to purchase its own shares. In order to buy back own shares, the company should comply with the following conditions. First condition, a company may purchase its own shares out of its free reserves, the securities premium account, or the proceeds of the issue of any shares or other specified securities. I repeat, a company may purchase its own shares out of its free reserves. Companies can use free reserves or securities premium account or the proceeds of the issue of any shares or other specified securities, but one condition attached to it, provided that no buyback of any kind of shares shall be made out of the proceeds of an issue of the same kind of shares. If we explain it through an example, in order to find out the amount for the buyback of equity shares, we have no provision to issue equity shares. We can issue preference shares or debentures for that purpose. Our second condition is this: all the shares of buyback are fully paid up. All the buyback of shares are fully paid. Third condition, the buyback is authorized by Articles of Association. The buyback is authorized by Articles of Association. Fourth condition, a special resolution has been passed at the general meeting of the company authorizing the buyback. Special resolution passed in the general meeting of the company authorizing buyback. Fifth condition is this: the buyback doesn't exceed 25% of the total paid up capital and free reserves of the company. The buyback doesn't exceed 25% of the total of paid up capital and free reserves of the company. Sixth condition is this: the ratio of the aggregate of secured and unsecured debts owed by the company after buyback is not more than twice the paid up capital and free reserves. That means debt to capital and free reserves ratio is not more than 2. Debt to capital and free reserve ratio is not more than 2 after buyback. Seventh condition is this: the buyback of shares listed in any recognized stock exchange is in accordance with the regulations made by SEBI in this behalf. Seventh condition, the buyback of the shares listed in any recognized stock exchange is in accordance with the guidelines made by SEBI in this behalf. Eighth condition is this: buyback must be completed within a period of 12 months from the date of passing of special resolution. Buyback must be completed within a period of 12 months from the date of passing of special resolution. Ninth condition is this: after the completion of buyback, a company cannot issue same kind of shares for a period of 24 months. I repeat, after the completion of buyback, a company cannot issue same kind of shares for a period of 24 months. These are the conditions to be observed at the time of buyback of shares. Then we discuss about reasons for buyback. Reasons for buyback. First reason, to achieve an optimum capital structure. Second reason, to increase its share value. Then third reason, to reduce the capital base and thereby injecting more flexibility. Fourth reason, to return surplus cash to shareholders. And the fifth reason for buyback, to support share price during periods of weaknesses. These are the reasons for buyback. Then we discuss about methods of buyback. Methods of buyback. Buyback of shares can be made either through tender or from open market. There are two methods. First method through tender and second method from open market. Firstly, we discuss about buyback through tender. Buyback through tender. Under this method, shares are bought back from the existing shareholders on proportionate basis. Under tender, shares are bought back from existing shareholders on proportionate basis. Company fixes a price at which it wishes to buy back a specified number of shares from its shareholders. If the number of shares offered for buyback at stated price is more than the number of shares to be bought back, the company bought back shares from each shareholder proportionately. I repeat, if the number of shares offered for buyback at a stated price is more than the number of shares to be bought back, the company bought back shares from each shareholder proportionately. Then we discuss about the term escrow account. Escrow account. A company has to open escrow account if it wants to initiate the process of buyback of shares. A company has to open escrow account if it wants to initiate the process of buyback of shares. The word escrow means contract or bond deposited with a third party. The word escrow means contract or bond deposited with a third person. In most of the cases, that third person is a bank to perform its obligations under the scheme of buyback. To perform its obligations under the scheme of buyback. I repeat, the word escrow means contract or bond deposited with a third person. That third person may be bank to perform its obligations under the scheme of buyback. The company has to deposit 25% of the total amount payable on buyback up to rupees 100 crore plus 10% of the amount payable in excess of rupees 100 crore. The amount will be returned to the company after completion of all obligations. The amount deposited in escrow account will be returned to the company after completion of all obligations. Second method of buyback is buyback from open market. Buyback from open market. A company can buy back its shares from the open market. This is done either through stock exchange or through book building process. Through stock exchange with electronic trading facility or through book building process. Book building process we know prices are quoted by shareholders at which they are willing to sell the shares. In book building process, prices are quoted by the shareholders at which they are willing to sell the shares. Then we discuss about accounting treatment of buyback. Accounting treatment. At the time of buyback, the following points are noted. First point, only fully paid up shares can be bought back. Only fully paid up shares can be bought back. If all securities are partly paid up, they must be made fully paid up by making final call. Second point, if shares are bought back by using free reserves or securities premium, an amount equal to nominal value of shares to be bought back should be transferred to capital redemption reserve account. Second point, if shares are bought back by using free reserves or securities premium, an amount equal to the nominal value of shares so bought back should be transferred to capital redemption reserve account. Third point, the premium payable on buyback must be write-off to securities premium or free reserves. Premium payable on buyback must be write-off to securities premium or free reserves. And fourth point, discount on buyback must be transferred to capital reserve. Discount on buyback must be transferred to capital reserve. And the fifth point is this, CRR, capital redemption reserve can be used for the purpose of issuing fully paid bonus shares. CRR can be utilized for the purpose of issuing fully paid bonus shares. Then we discuss journal entries required at the time of buyback. First journal entry, when fresh shares are issued for buyback. Journal entry, bank account debtor to share capital account. Second journal entry, when buyback is done out of free reserves. Entry, reserves account debtor to capital redemption reserve. Third journal entry, when shares are bought back, we know we can bought back shares at par, at premium or at a discount. At par, share capital account debtor to bank account. at premium, share capital account debtor, securities premium or reserve account debtor to bank. Then at a discount, share capital account debtor to bank to capital reserve. Fourth journal entry, when buyback expenses are paid. Journal entry, buyback expenses account debtor to bank account. Buyback expenses account debtor to bank account. And fifth journal entry, when buyback expenses are charged to profit and loss account. Journal entry, profit and loss account debtor to buyback expenses. These are the journal entries required at the time of buyback of shares. Then we solve one problem. Our question, A Limited had 1 lakh equity shares or rupees 10 each, of which bought back 40,000 equity shares at the rate of rupees 9 per share. For that purpose, company issued 2,006% preference shares or rupees 100 each at rupees 110. Here we are issuing preference shares at a premium of rupees 10 per share. The company had rupees 1 lakh in its securities premium account and rupees 1,20,000 in general reserve. Give journal entries. This is our question. Then our solution. Nominal value of shares bought back 40,000 shares. It's nominal value per share rupees 10. 40,000 into 10, that comes to 4 lakh. Less proceeds from fresh issue. Here we are issuing 2,000 preference shares, nominal value per preference share rupees 100. So 2,000 into 100, that comes to 2 lakh. 4 lakh minus 2 lakh, that comes to rupees 2 lakh. So balance to be met from free reserves is equal to 2 lakh. Then our journal entries. Our first journal entry for issue of preference shares. Here we are issuing 2,000 preference shares or rupees 100 each at rupees 110. Our journal entry, bank account debtor 2,20,000 to 6% preference share capital account 2 lakh to securities premium 20,000. Second journal entry, buyback of 40,000 equity shares at a discount of rupees 1 per share. Journal entry, equity share capital account debtor 4 lakh to bank. Here we are paying rupees 9 per share. 40,000 into 9, that comes to 3,60,000. Then to capital reserve 40,000. Then third journal entry for transferring amount to capital redemption reserve. Our journal entry, securities premium account debtor 1,20,000. Here we have already 1 lakh in our hand. And then by issuing preference shares we got 20,000. So securities premium total, that comes to 1,20,000. Securities premium account debtor 1,20,000. Then general reserve account debtor 80,000 to capital redemption reserve 2 lakh. These are the journal entries required here in this problem. I think the topic explained here, buyback of shares, with this illustration is clear for all of you. We will meet again. Till then, goodbye.